What's up, traders? Welcome back to the channel. Today we're talking about scalping, and I know that this video might upset some other people, but I'm going to be talking about why I'm not a huge fan of scalping. I'm not going to say right off the bat, I'm not going to say that scalping is impossible. I'm not going to say that you can't do it profitably, because I'm sure that there are some people out there that have had some success with it, but I'm going to tell you why I think scalping is way harder than trying to day trade, or my favorite type of trading, which is swing trading. I'm going to talk about scalping, some of the disadvantages that come with it, as well as some of the the troubles that scalpers have. So stay tuned, let's get into it. Guys, welcome back to the channel. My name is Nick. I talk all about trading and investing, and today we're talking about scalping. Now, if you don't know what scalping is using things like the 5-minute chart, the 15-minute chart, and the 1-minute chart to try and make short-term predictions or short-term trades as to where you think the market will go in maybe the next 30 seconds or minute or 5 minutes. Now, there are some people who really swear by scalping, but I personally don't think that it is a very easy thing to achieve. Now, none of trading is, but let's talk about some ways that scalping is tricky. Now, when we are looking at those lower time frames, when we are looking at the lower time frames, right? I'm talking again about things like the 15-minute, talking about the 5-minute, and the 1-minute chart. The problem here right off the bat that I see with using these low time frames is that a lot of what happens in the very short term in the markets is noise. And that is inevitably one of the biggest problems for scalpers is this move on the 1-minute chart actually a significant, meaningful move to the upside, or is it just noise and a random spike that will get erased in the next 2 minutes, right? It's kind of tough to gauge that. Now, when you look at something like a daily chart comparatively, right, you could see a daily move that is based on, for example, yesterday we had vaccine news, which pushed the market up. That is a pretty validated move in my opinion, because it was a full day's worth of transactions and money being exchanged to make that market push higher or lower, right? So that to me is a little bit more meaningful than just a random spike 5 pips up or 5 pips down on the 1-minute chart. So to me, the first big problem there with scalping is going to be the noise that is going into the market. Think about all the different stuff that's going on into making the markets move up and down. There are so many variables that we couldn't even count them. There's interest rates, there's technical analysis, there's a tweet coming out. There's so many different things that are moving the market up and down. And so using those really low time frames to me can be very tricky because a lot of it is in fact noise. Now, the other thing, the major problem that I see with scalping, the toughest part of it, is that not only do you have noise against you, but you also have quite an expensive trading expense to placing and executing trades on these lower time frames. So let me dive into that. So what I mean by that is that it is expensive to trade these lower time frames. Because if you're taking a trade on something like, let's say, the 5-minute chart, right? Let's say that you are going for something really quick. You're in, you're out of the market, and you're looking to just make 5 pips and get out of the market, okay? Well, if you're using a stop on your trade, which I personally recommend for most trading, right? If you're using a stop loss on your trade, let's say that you were risking 5 pips to make 5 pips, just as an example, okay? So if we were risking 5 pips, okay, to make 5 pips, I want to show you guys something that I thought about this morning that was very problematic for scalpers, okay? So if we're gonna risk 5 pips to make 5 pips, now I know you might say, well, Nick, I would usually risk 5 pips to make 15 pips, but just for the sake of this point that I'm gonna make, let's imagine that you're just going for a 1-to-1, meaning you're risking 5 pips and you're taking profit at 5 pips. Theoretically, if you have like a good performance, like if you're able to call the market well, let's say you have like a 65-70% chance of correctness, maybe you risk 5 to make 5 and you're just going for that quick in and out and you think that the market's gonna drop, just for an example. Well, here's the problem. If you are trading most currency pairs, the spread alone is going to cause a big problem for trying to scalp these super short time frames, okay? And here's what I mean. If you are risking 5 pips, but you have to pay 1 pip that's gracious, right? Because a lot of currency pairs like GJ, Aussie Canadian. It depends what you're trading. But if you're trading those pairs, they cost 2, 3, 4 pips even to get in and out of the market. That's called the spread, and that's how brokers make money. Well, let's say you're trading something like Euro USD, which has for the most part, the tightest spreads. And let's just say you're paying 1 pip of spread to get into a trade. Now again, when you enter a buy position, the spread is what the broker is going to make money. They give it to you at slightly higher of a price, and they take a little bit of spread, and that's how they make their money, right? Well, if we're risking 5 to make 5, and we cost us 1 pip to get into the trade, check it out. We don't enter, so I'm going to try and draw this as a graph. Let's say that, okay, here is our 5 pip stop loss and our 5 pip target. So let's say that the take profit here is plus 5 pips, and the stop loss here is minus 5 pips. Well, check this out. If we get into the trade, right off the bat, we pay, if we're long, we pay 1 pip of stop loss, okay? Or I'm sorry, 1 pip in spread. So instead of getting in right here where we want to be, right, we actually get filled a little bit higher than we wanted to because we are buying, right? So we actually get filled right here, okay? Now, stay with me here because this is, again, this is problematic. Suddenly, our stop loss right off the bat is no longer 5 pips away. It's actually 6 pips away because, again, we got filled up here. So this distance went from 5 pips to 6 pips of loss, of stop loss. And the gain now is 4 pips away, okay? And remember, the price is still down here. The price is still actually here. Now, the reason this is significant is that if price decides to drop here, we are actually closer to our stop loss, or we are risking more than we are potentially making just from the beginning of our trade. From the beginning of the trade, we are at a significant disadvantage here because price has to come up 5 pips just to give us a 4 pip profit, whereas price has to go down just 5 pips for us to lose 6 pips of loss. I hope that makes sense. I know it's a little bit confusing, especially for some of the new traders, but the thing here is, the main point is that the trading expenses of trying to scalp are very, very tricky to overcome. Now let's compare this really quick to something like a swing trader and how a swing trader might deal with this. So again, the idea here is that what if we compared that concept compared to something like a swing trade, okay? And this is more what I do. Let's say that instead of going for 5 pips profit, 5 pips loss, let's say that we are actually going to go for 100 and let's say we go for 200 pips take profit, 200 pips stop loss. Again, not a great risk reward, but just for the sake of example, let's say that if price goes in our favor, we're looking for 200 pips, and if price goes against us, we're looking at minus 200 pips. Well, again, same concept. We pay the same spread for a swing trade, meaning we pay 1 pip, right? Well, again, let's assume we're trading Euro USD, and this is definitely not drawn to scale, but at this point, we get filled on the trade at, again, slightly higher than what we wanted to because we're buying the market. We get that spread, we pay the broker a little bit, and from the start of the trade, we are down 1 pip. But think about it this way. If price drops to the stop loss, we're gonna lose 201 pips, okay? And if price rises to our take profit, what are we gonna make? Well, we're gonna make plus 199 pips, okay? And the reason that this is significant is look at the comparative difference, or the percentage difference of our initial trade where we were taking 5 pips to make 5 pips, right? Where when we lost, it was a significant chunk of the loss was just the spread. In this case, the spread is minimal. In this case, because the spreads are tight on Euro USD, if we lose 201 pips compared to 199 pips in profit, it's a very slight disadvantage for us as traders. In fact, I think it's less than it's like 0.25%. Somebody maybe correct me on that math in the comments, but the idea here is that for the most part, when we are taking swing trades and paying that spread, we have a much more marginal amount of cost to our trades by getting in and out out of the trades compared to a scalper who is paying a tremendous amount of money compared to their trade to the broker. It's costing them a lot, okay? So this is a little bit more advanced than some of my other videos, but the concept here is that scalping, in my opinion, is a very tricky game because you are paying the broker quite a bit of money. Now, if you think that you can, get in and out of the market really quickly and make money, then, feel free to disagree with me, but this is just my opinion after time in the market. To be fair, I haven't spent a tremendous time trying to scalp the markets and study strategies. For me, it's always just been one of those things. For the most part, from the start of the trade, you are very, very disadvantaged with that costly spread and commissions that the broker offers you. Compared to if you're swing trading, that spread and commission is pretty marginal. It's not that much, and that's really not going to set you back tremendously. So, in my opinion, there's a lot more troubles for a scalper than a swing trader. And I think personally, I'm a little bit biased because I swing trade. That's like primarily what I do. It takes me less time. I really like that aspect of it. Again, I'm not saying scalping is impossible, but I'm saying you should be aware of the costs and the challenges of a scalper before you try and jump in and scalp. Now, I will say this, day trading also has some of that issue as well, because if you are going for something like a day trader maybe goes for 20 pips, 30 pips, right? That spread and commission is still slightly significant to that trade, right? Because if you're one pip, it costs you 1 pip to get in the trade, and you're going for 20 pips, that's not a ginormous amount of the trade, but it is a portion of the trade, and it does cost you something to get in and out of trades. So you have to think about these trading expenses, guys, when you are setting up for your trading strategy. I hope this didn't burst anybody's bubble. And again, I don't think it's impossible. I just think that you should be very aware of the costs of trading and the different types of trading. I personally think that the most advantages are in swing trading. I know some people that have success with day trading though, so I'm not going to say that is impossible either. Just my 2 cents, just my opinions, and some concepts that I thought about today. If I made any mistakes, feel free to comment. Let me know down below in the comment section, and I'll be reading along. Thank you guys so much for watching. I hope you have a great rest of your day, and we'll see you back in the next video.